Good morning. Welcome back to the Genius Malpe channel. Glad you could join us. It's going to be one of those extra boring days. For those of you who enjoy the most boring channel on YouTube here, the Genius Malpe channel, we've got a lot of words to look at, not a lot of graphics or cool images, but there's going to be some fun discussion, and we'll hopefully save the best for last. So the dedicated few, the 3 or 4 of you that actually stick around for the duration of these videos can get the most meat and potatoes out of it. We got a headline here, got a lot of headlines, but this one here, gold investment roars in Japan on North Korea tension, but rate rise talk hits price as stocks rise. After 8 months of inactivity, Japanese retail investment for gold suddenly roared back to life in September, says a note from specialist analysts GSFM's director Cameron Alexander, highlighting the repeated missile and nuclear tests by neighboring North Korea. What is wrong with silver? Is it being manipulated? We covered this recently. There have been accusations of manipulation for quite some time, and there have been arrests made for some precious metals manipulations. There is considerable evidence that silver is subject to considerable manipulation. Revelations of manipulation from regulatory investigations and lawsuits in recent years have led to the introduction of stricter regulations and oversight. These should help to minimize manipulation and lead to higher silver prices as supply and demand fundamentals reassume their traditional role in price making. The divergence between gold and silver, which now sees the gold to silver ratio well above its historical average, has created an opportunity for investors to acquire the white metal at a discount. White metal has not traded for a sustained period above the psychologically important $20 per ounce barrier since August of 2014. And there you can see a chart depicting the silver priced in US dollars. We won't be covering the entire article, but we'll hit some of the highlights here. Among some of the most popular forms of speculation have been claims of market manipulation, and that alternate digital currencies, such as Bitcoin, have attracted the attention of investors that would typically be attracted to silver. While these claims may reflect some changes in the attitude of investors and the falling popularity of silver among alternate investors, the reality is somewhat different, with market manipulation being among the most likely reason for silver's extreme volatility and prolonged slump. Does the tremendous volume of paper silver lead to market manipulation? One of the primary reasons for silver's continued weakness is the tremendous volume of paper silver that exists, notably when compared to gold. Back in 2014, Bloomberg published an article speculating that the paper silver is roughly 250 times larger than the market for physical bullion. At the time, silver was trading at around $20 per ounce, so that claim was based on the assumption that with annual silver production coming in at 1 billion ounces, the market for bullion was valued at $20 billion. Yet Bloomberg hypothesized that the paper silver market was valued at $5 trillion, which is 250 times the value of physical bullion. If we turn to data from the Silver Institute to gain a more up-to-date picture, it can be seen that the total volume of paper silver trading on world exchanges in 2016 came to 159 billion ounces, or was 136 times higher than physical bullion. According to an analysis of silver registries, there are 29 registered owners per ounce of physical silver available, underscoring the considerable leverage created by silver contracts. Now, how often have I talked about that with paper contracts and paper metals? You don't own it. There's a bunch of people looking at the very same bar from windows in a room thinking that it belongs to them. Fears of being perceived to be manipulating the silver price have caused participation in the London Fix auction to wane, leading to lower orders, reduced liquidity, and consequently higher volatility for silver. That has led to huge, unpredictable price fluctuations that have caused it to diverge widely from the spot price since January 2016. This is damaging the credibility of this benchmark price setting mechanism and highlights the issues that surround making the price for silver. Bottom line, while much of the evidence supporting claims that silver is being manipulated is only anecdotal and circumstantial in nature, there is something clearly amiss, as the breakdown between supply and demand fundamentals and the price of silver indicates. The divergence between gold and silver, as highlighted by the gold to silver ratio, widening by ounces since the start of 2017 and being ounces higher than the 40-year average, has created an opportunity for investors. Speaking of paper silver, paper metals, look at this article talking about these suit monkey clowns, these gold paper traders. The largest gold ETF highlights bullion traders' confusion. Funds put to call ratio is at the highest since August of 2015. Investors have poured money into SPDR for 5 straight weeks. Gold traders are getting pulled in two different directions. On the one hand, investors are awaiting clues this week on the timetable for reducing the U.S. Federal Reserve's balance sheet, which could curb demand for gold. Rising equities are also hurting the metal's appeal. On the other hand, mounting U.S.-North Korea tensions and concern over the economic outlook reinforce the case for owning bullion, which has gained 14% this year. The dilemma is playing out in exchange-traded funds. The put-to-call ratio of SPDR Gold shares, the largest ETF backed by the metal, is the highest in 2 years, signaling bearish sentiment may be gaining momentum. At the same time, investors poured $177 million into SPDR Gold last week, a 5th straight weekly inflow, while hedge funds and other large speculators boosted bullish bets in gold futures to the highest in a year. Money managers boosted their net long position in gold futures and options contracts by 6.1% in the week ended September 12th, according to Commodity Futures Trading Commission data. Bullion climbed 70% from December 2008 to June 2011 as the Fed bought debt and held borrowing costs near 0%. That era of easy money is ending as the Fed raises borrowing costs and policymakers prepare to shrink the $4.5 trillion balance sheet. Good luck with that. That is never going to happen. It's pretty bleak, I believe, for the Fed, and I don't think they have a lot of options left. I think the U.S. dollar, as I stated in a previous video, is facing an extinction level event. The U.S. dollar is like a Tyrannosaurus Rex, 2 weeks before the next ice age, and it's starting to snow. Richard Silla, Human Civilization at Momentous Turning Point with Record Debt Levels and Ultra Low Interest Rates. This is a lengthy article, so we won't be able to cover all of it, but we will again hit some of the highlights here. Credit patterns and peak civilizations. In a history of interest rates, Silla identified an interesting pattern corresponding to the rise and fall of major empires. When we look at interest rate trends, it seems like there is a U-shaped cycle for each civilization, he told listeners. At some point, they reach a peak, and then slowly trended down over time. Then, after getting as low as they can possibly get, they start to trend higher again, but usually with much, much higher debt levels. This was a pattern seen with Babylon, Greece, and even Rome. Applying this analysis to the present, we see that we had a run-up of very high interest rates peaking in 1981, with a dramatic fall to near zero or even negative, Silla stated. But now we're beginning to see rates creep up, and this could be the beginning of the final stage of the cycle, Silla said. We might say that our current low interest rates indicate that we're at one of the high points of our civilization, he said. Maybe things will get worse from now on. Today's market's unprecedented. Since the last edition of the book in 2005, we've seen a totally unprecedented series of events. We've experienced the lowest interest rates on a very wide global scale for the first time in millennia, Silla noted. For 5,000 years, interest rates remained in a narrow range. The last peak of around 20% occurred under Hammurabi in Babylon, Silla added. We didn't hit that level again until 1980 and 81. Since then, we've seen the long decline to our present state. Someone alive today who remembers the last 40 or 50 years can feel they've been a part of a special period of interest rate history, from the extreme highs to the extreme lows in U.S. history, he said. This is occurring over a period where the United States government debt has been seen as a benchmark and safe haven around the world. That's been very valuable to the United States, Silla said. I sometimes think we're abusing the privilege a little bit. The national debt was $1 trillion in 1980. Just 10 or 12 years ago, it was $10 trillion. Now it's $20 trillion. As interest rates go up, the government is going to have to pay more money to finance its debt, which has implications for the budgets. On top of that, we have to consider unfunded liabilities, including the Social Security system and Medicare system, both of which face serious financial shortfalls in the future. Let's transition that last piece into this article by James Rickards. A financial H-bomb has exploded. Somebody exploded an H-bomb last week, and it wasn't North Korea. It was the U.S. This was not a kinetic H-bomb, the kind that leaves a mushroom cloud. It was a financial H-bomb. Financial warfare has its weapons, tactics, and commanders, the same as kinetic warfare. In financial warfare, the leading commander is the Secretary of the Treasury. The weapons include account freezes, sanctions, and financial blacklisting of certain individuals and companies. The financial warfare equivalent of an H-bomb is a complete ban from the U.S. dollar payment system. The U.S. dollar represents 60% of global reserves, 80% of global payments, and almost 100% of global oil sales. Cutting off any part from U.S. dollars is like cutting off the oxygen from a patient in intensive care. They won't last long. That is exactly what U.S. Secretary of the Treasury Steve Mnuchin threatened to do to China on September 12th. He threatened to cut off China's access to the U.S. dollar payment system if China does not rigorously enforce new UN sanctions on North Korea as a means to deter North Korea from pursuing its nuclear weapons and missile development. Likewise, China will not enforce the sanctions beyond superficial compliance. They certainly will not go to the lengths the U.S. expects. China fears a destabilized North Korea that could be reunified on South Korean and U.S. terms. China fears a flood of North Korean refugees entering China, and China views the entire North Korean situation as a U.S. problem, not a Chinese problem. Russia views it the same way. A war between the U.S. and North Korea is not the worst result for China because it bleeds the U.S., Japan, and South Korea, who are rivals for dominance in East Asia. Finally, Chinese behavior is governed by face. By the U.S. Treasury making such a public declaration, China cannot back down without losing face. In an age of rising Chinese power, China will not lose face. Cutting China out of U.S. dollar payments means a selective default on U.S. Treasury debt. China has over $1 trillion of U.S. government securities in its reserve position. Those securities are paid at maturity and rolled over through the U.S. dollar payments system run by the U.S. Treasury with the Federal Reserve as fiscal agent. If China is denied access, then China's Treasury securities portfolio is effectively frozen. China is relying on those liquid dollar reserves, both to bail out its insolvent banking system and to defend its currency. The implications of freezing China out of dollar payments are almost incomprehensible. So the path is set. North Korea is going for the weapons. The U.S. will not allow North Korea to get them. The U.S. is relying on Chinese help, which will not be forthcoming. The end result is a shooting war with North Korea and a financial war with China. Investors should move now to lighten equity exposure, establish selective short equity positions, and increase allocations to safe haven assets such as U.S. 10-year notes, gold, silver, and cash. This war is coming in 6 to 8 months. The time to make your financial moves is now, before it's too late. Regards, Jim Rickards. As always, an interesting perspective from Mr. Rickards. Something to consider, but also to be taken with slight grain of salt. However, the circumstances in which he discusses these global politics and the effects on the economy and on the dollar and on metals, I think are all valid points and things that we should consider when evaluating our financial decisions going into the coming year or two. Again, don't shoot the messenger, but interesting report here. I saw some statements earlier this week by an unmentionable, who I will not mention, who had some derogatory things to say about Bitcoin. And today we see Ray Dalio, founder of the world's largest hedge fund, saying Bitcoin is a bubble, unquote. Now, quick defense of the Bitcoin crowd. People have been calling it a bubble for a long time, ever since it was $100, $800, $1,000, $2,000, $3,000, $4,000. So, yeah, they have done well. They've had a quite successful run. Now, does that mean it's not a bubble currently? Who's to tell? Who's to know? This individual, Ray, says that Bitcoin today, you can't make such transactions in it. You can't spend it very easily. Bitcoin is a bubble. This is what he said on Squawk Box on Tuesday. Now, I understand that, yes, you can do numerous transactions in it, and you can spend it in multiple locations, including Amazon and other ways. So he might be somewhat flawed there. However, I do agree that it's not that easy to perform transactions with Bitcoin. I do feel that it's too complex, too complicated for the average general consumer and general user, especially when you look at it on an international level. I can tell you and attest from my own personal interactions with everyday common people and people from all walks of life that very, very many people, I would say the overwhelming majority, 98% of the people that I know, and I know a lot, pretty active in certain communities and demographics, they do not know, understand, comprehend, or have a desire to employ, execute, or transact with Bitcoin in any way. And so he says here it's not an effective storehold of wealth because it has volatility to it, unlike gold. Yet gold can be volatile. I mean, I will agree that there's times where it fluctuates in its valuation in US dollars and what the amount of dollars it is required to purchase a fixed amount of gold. And I would say that, yeah, Bitcoin also shows and displays some very volatile behavior. And I also understand that Bitcoin was patterned after, and the programs and such that created the blockchain and everything were designed to somewhat mimic the behavior of gold with a slow expansion rate, and a somewhat fixed supply and an ability of people to transact with it somewhat anonymously. It has a lot of those good free market, I guess you could say, anarcho-capitalist attributes to it. However, it's not something that's physical. It doesn't really, to me, have an intrinsic value. And I know that's a debatable realm. So we're not going to use this as a way to dive into all that. We're just touching on this particular article and statement. Bitcoin today, you can't make much transactions in it. You can't spend it very easily, Dalio said on CNBC's Squawk Box. It's not an effective storehold of wealth because it has volatility to it, unlike gold, the hedge fund founder added. Bitcoin is a highly speculative market. Bitcoin is a bubble. The investor said there are two important facets to being considered a valid currency: ease of transactions as a medium of exchange and being a storehold of wealth. It's a shame. It could be a currency. It could work conceptually, but the amount of speculation that is going on and the lack of transactions hurts it, he said. I think he's got a good point there. I think a lot of the the fervor surrounding Bitcoin is the ability to make a quick buck or to invest and make some money with it right now, because it's going to be speculatively worth far more than it is right now. You know, people are saying, oh, it's going to be worth 10,000 and it's going to be worth 8,000, and people put money into it hoping to make that. Some people panic when it drops, they might sell, but a lot of the activity taking place around it is in that world, not as a medium of exchange where, you know, if I put a vehicle on the market right now, I guess I could sell it for Bitcoin, and there are people transacting with it. And I guess a disclaimer that I should include with this, because, you know, I do keep tabs on and in touch with Bitcoin, and I do have friends and members of this particular channel that are Bitcoin advocates and users. I applaud what it's doing and how it's challenging and disrupting the money monopoly game that the controllers, the central bankers, and the governments seem to have a grip on. So in that way, I applaud Bitcoin. I've been, you know, one of those, I guess, I don't know, a Swiss neutral. At times, you know, it appears that I'm more negative or against it. That's just because I'm so pro metal that it's you can't shake it. It's, you know, I'm hardcore with the gold just based on my own personal beliefs and history. But when it comes to Bitcoin, there's times where I think I'm like right there, right on the verge. You know, almost like Swiss neutrality. You know, I could swing over there and heck, I even have some. Remember, I've got that little bit wallet that some gentleman here on the channel gave me and helped me open up, and then there's like .008 Bitcoin in there. So I can actually say that I do hold a fraction of it. You know, good luck with it to all of you, but be careful, be cautious, be alert. I'll tell you right now where I'm at personally. If I was in Bitcoin, I guess it's hard to say. If I was sitting on, let's pretend, 1,000 Bitcoin, what would that be right now? Oh, it's sick to even think about. It's like $4 million. I would truly take out, if I only had a little bit invested in there. I don't know when I'd, hypothetically with this story where we're going, when I would have gotten into it. But let's pretend we're up 2 million right now from what we put in. I would seriously consider taking a lot of my profits, if not all of them, off the table. You know, take $2 million, buy 500,000 or $1 million worth of precious metals, heavy on the gold, and maybe put a good cold million into some real estate holdings, some rentals, you know, maybe a nice domicile for myself, nice dependable vehicle, nice rural area, get some food, get some other things, and just make the appropriate preparations for a time when perhaps no currency has value whatsoever other than the tools and the skill sets of which we are equipped. All right, well, there you go. That's that little piece at the end there. Random thoughts. Hope all of you have a pleasurable rest of your day. Thanks for tuning in to the Junius Maltby channel. Have a good day.